Welcome again, everyone, to this new DigiShares webinar. This will be about assessing and mitigating risk in security token offerings. We have some great speakers. We have two legal experts, one from the US, Gary, one from Spain, Javier, and we have a general risk assessment expert in Raveena, who's joining us from Austria. And yeah, we'll get started without further ado. One housekeeping element: if you wish to ask questions, please use the Q&A section of Zoom in the bottom and not the chat section. Very, very important. Makes it much easier for us to answer either live or in written form, and to manage everything. So thank you in advance for that. So yeah, we can get immediately started with Raveena from Particula, and she'll focus on financial and blockchain related risks in security token offerings, and of course we'll let the lawyers focus on legal and regulatory elements both in the US and EU. So with that, Raveena, the floor is yours.
Thanks, Gabriel. Let me share my screen. So I'd like to start by explaining the need to assess the setup of a STO when assessing its risk, especially its financial and blockchain risks. These tokenized financial assets, or STOs in this category, have unique product features. So these unique product features come from the fact that there is essentially an underlying asset that's being tokenized, which is a tokenized representation of a legally enforceable claim to the underlying asset. And this is done through the use of blockchain features and the smart contract logic. So at this stage of tokenization, the product features change and introduces different risks associated to it. So tokenization does not change anything to do with the underlying asset, but how investors actually interact with it, how investors actually how is an asset fractionalized and how it is transferred, how it is valued. So as well as when a tokenized asset or an STO begins to be distributed and traded and offered to investors across different platforms, it also introduces different intermediaries. For an example, like Oracle price feeds providers and digital asset custody providers. So this setup with unique product features introduce different layers of risks. So I would like to take an example and explain these different layers of risks and different layers of product features. So I'm sure everybody in the tokenized asset space is familiar with the BUIDL token offered by BlackRock, and it is issued as a tokenized share of a private fund that is based in British Virgin Islands, and the token is distributed by Securitize, and it's offered on 6 different blockchain ecosystems. And moreover, like other DeFi providers like Ondo Finance, Mountain Protocol also use the BUIDL fund as an underlying asset. So these different layers involved in a token introduce risks in financial and blockchain risks in different ways. So it's a complex system, and some of the financial and blockchain risks that we see are like the legal uncertainty. So for I'm sure the other speakers would enhance on this, but on a financial level, it's important to understand the issuance structure, because when assessing the risk associated with traditional financial assets, we always look at the issuer's creditworthiness or the issuer's ability to sustain itself in case of insolvency. But when a tokenized asset, or when a security token offering is there, it has a separate issuance structure. And this issuance structure, how does it enforce the ownership to the underlying assets? And then it's also about what sort of governance rights are associated with it. Then the most important factor comes with the network security. When it is offered in different blockchain ecosystems, it introduces different levels of risk. A token can be offered on Ethereum, on Polygon, or on Solana, and it can have different models of governance, different levels of technical features. So being aware of these technical features helps an investor to assess a token offered on which platform he or she should choose. And also, when a smart contract is designed, the smart contract actually translates the off-chain product features into technical logic. So what sort of controls are available? What sort of access controls are in place? And what sort of compliance measures are in place should be examined. And of course, then the regulatory compliance comes into place. So this includes this compliance measures integrated into the smart contract. And the next most important thing for an investor to assess is how are the underlying assets custodied, and what sort of rights does the investor have with the custodian, and what sort of digital asset custody providers are used. Is it a self-custody offering, or does the issuer use a third-party service provider for digital asset custody? And how are the private keys managed? So an investor can find these informations usually in the terms and conditions of an offering. And again, when security token offering is available across different blockchains and different DeFi platforms, then you also have considerations regarding the pricing mechanisms, the valuation mechanism, and introduces other financial concerns like the market depth according to what type of platforms the token is made available on. And finally, when an investor buys a token, they should also consider about the scalability of a token, and how long has this how long ago was this token issued, and what are the additional utility that's provided? Can an investor actually collateralize this token, or when such additional utility is available? So what's the market depth? What are the other exit options available for an investor? So these factors together give a very multi-layered risk approach. So it's no longer about assessing like issuers' balance sheet health, or about issuers' creditworthiness, or about issuer stability. So when assessing the risks of STOs, it's more about the different layers involved in a token, and understanding the technical implementation of the token, and understanding the market risk associated with it. We can also go more into detail about each of these financial risks that we have. So you have different risks that come with different financial risks that come also with like tax and accounting compliance. When when a STO is issued across different jurisdictions, you have to consider how would this asset be considered when it is included in the balance sheet, and what are the tax implications it has. And then investors should also consider about the settlement risks. So when it is offered on different blockchains, it has different settlement times, and it also has different conditions. So there could be a mismatch between the settlement time of the actual underlying asset and the token. When a token is offered across, when it is wrapped, or when a token is wrapped, or when it is offered in different DeFi platforms for other structured products, then you need to consider the multiple claims that it has, what sort of terms and conditions that it would involve. And also, again, when considering the on-chain execution risk, you need to consider about you need to consider if the smart contract has been audited, or the concerns found in the smart contract, has it been resolved and mitigated at the moment, and what sort of fee structures are implemented. There could be different fee structures with the type of blockchain that is used. So investors need to consider these risks when they actually think about STOs. And moreover, these risks have become more immediate. The exploits have become exploits in blockchain ecosystems have become more immediate, and therefore these risks need to be assessed in real time, and that's what Particula as an organization is doing, offering analytics and risk ratings for digital assets. Yeah, so I'd like to hand over now. Yeah.
Thank you so much, Raveena. Just to make things clear for the audience, an issuer of a security token can go to Particula and basically get a score from you guys, so that it helps their potential investors understand what they're getting into, and to make a better informed decision. Is that a good way of putting it?
Yes, yes. We assess the token on all levels. We assess the issuance structure, the token's technical implementation, the underlying asset, and we provide it a score, a risk score, so that it becomes comparable, because tokens have different underlying assets. So you need to have a comparable measure to look at it. To look at different tokens. So we categorize different risks, and then we give a score so that it becomes more comparable in the market.
Got it. So you're kind of like a rating agency, but in the Web3 world. So kind of like a Standard & Poor's or Moody's or Fitch, but for security tokens, which is really cool.
Yes, that's right.
Yeah. So thank you so much for that. I wrote down two questions, which I'll keep for our Q&A session at the end. So we're gonna have like a fireside chat Q&A session. I actually just see that questions are pouring in. So I'm gonna just briefly see if there's one for you right now, Raveena. So let's see. So Jeff is asking, is the particular risk score determined only within EU and US markets, or are other jurisdictions considered as well?
We consider all jurisdictions. So far, we have assessed products in US, products based in the US, the EU, Mexico, El Salvador, so in Singapore. So there are, the jurisdiction does not matter. We consider the jurisdiction in our assessment. What type of regulatory frameworks are there? What type of compliance requirements are there? So we consider this in our assessment.
Got it. And so do you work with lawyers in each jurisdiction to identify like do you have a scoring mechanism for jurisdictions themselves?
Yes.
How does that work?
We do have a scoring mechanism for different jurisdictions, and we also consider legal implications from we have a lawyer based in the US currently that gives us expert opinions, but also we have to assess the compliance structures and the regulatory frameworks. We have also created this automated AI program that helps us in terms and conditions analysis. It's already fed with information from different regulatory frameworks.
Interesting. And we got a really good question from Stefan right now, asking whether the score that you give is a one-time score, or I guess the underlying question is it a static score or is it dynamic, and can it evolve over time?
Currently, the assessments that we give are at the point of time where we rate it. We consider all the past information that's available up to the point of where we rate it. But we are working on giving more real-time assessment because the environment is changing very rapidly. So we're currently in the process of making a more dynamic or a real-time assessment.
Got it. And if people are interested in seeing a case study example, like a detailed example of what a particular risk assessment looks like, can they find that on your website? Or
yes, on our website we have, after a rating, we always publish a rating abstract, like a short summary of what was considered, and then briefly it also discusses our analytical approach, how we rate them.
Got it. And then if you want access to the whole thing, you have to, it's
Yes.
on the issuer's platform when you invest, or?
Yes, and some issuers publicly share it. For an example, Animoy has publicly shared our rating, and they also have shared our rating abstract, like our final report that we wrote for them publicly.
That's great for transparency. So well done to Animoy. Haven't heard of them, but well done. All right, fantastic. So yeah, I'll save a few questions that I have maybe for the Q&A session after the presentations. So thank you for now, Raveena. We will shift to Gary, who yeah, has a presentation for us, and the floor is yours, Gary.
Excellent. Thank you. Hello, my name is Gary Romel. I'm from Allomer Law Group. I live here in Monterey, California. Let me see here. Let me share my screen. We specialize in starting companies on the blockchain or transitioning companies to the blockchain if they're not already there, and then executing security token offerings and connecting folks up with platforms such as DigiShares to get people rolling. Are we good on the screen, Gabriel?
Yes, we are. You're not full screen though, but I mean the presentation, but we can see it.
Okay. Let me stretch it out here. All the icons on there we go. Okay. Yeah. So assessing STO. So forgive me, I may cruise through some of these slides. They're thick, but people can always email me later and ask for the presentation. And some of this will be put on kind of LinkedIn as informational stuff. So what is a security token? Let's talk about that. Of course, everybody I think already kind of knows that. We're here. It's a digital asset that represents ownership or rights to an underlying investment, equity, debt in a company. This does not include cryptocurrency. So we're not talking about cryptocurrency here. It's subject to securities regulation. in whatever jurisdiction it's sold or, of course, originated. First, I know we're all issuers here. We're talking about starting businesses and helping the issuers, but let's first look at the investor perspective, because I think that's helpful from a regulatory viewpoint and from a risk viewpoint to look at what the investor wants to see. They want confidence that the company, the issuer, is credible. Your background, your expertise, your reputation, everything aligns. You are who you say you are, you live where you say you live, and you've done what you've said you've done. You can execute, you possess the skills and networking experience, you're committed, you're transparent, you disclose all material facts with no omissions, and of course, you're responsible with the capital, and you do what you say you're going to do with the funds. So of course, this is what they want. They also want a return on their capital. They want delivery on expectations you give them. So if you're an issuer and you're advertising or promoting, whatever promises or expectations are putting in the minds of these investors, i.e. a 15% return, a third of $1 billion of profits or $1 trillion or whatever you say you're going to make, that's what's going to be in their mind of an expectation. And they want clear terms, a good understanding of the business model and revenue streams that's going to occur. So what's the STO process overview? Looking at this from an entire process. If you're stepping in as a brand new company and you haven't started yet, that's easier. We can start at step one and we can say, okay, we're going to set you up in the jurisdiction we like for blockchain, and we can set your company documents up to reflect the kind of security and the kind of blockchain representation that we want to have. If that hasn't happened yet, if you're already an established company, you need an attorney or somebody to go in there and look at your documents and perhaps change jurisdictions and redomicile your company or alter your company documents at a fundamental level to represent the security token. Step two, once we've aligned that corporate structure and documents for this STO, we can begin to do the legal paperwork for that STO. And of course, there's legal compliance paperwork, government filings, and to choose the blockchain. And we'll get into the slides, we'll get into sort of executing the execution end on the legal compliance. And of course, we want to know the rules. To assess the risk, you want to know the rules and make sure you're just following the rules. Step three, the blockchain capital raise platform, steps in execution. We want to link up to a blockchain so we can essentially get that token or get that ledger viewable to the people that can purchase those interests. And we can link it as a back-end service, for example, to your company website. And this is where DigiShares comes in. You have your company website, you hit the button, DigiShares is now linked up on the back end, and we can begin to collect investors and track your cap table. One thing to note here, you need to carefully assess compliance with the Securities Exchange Act of 1934 when using or operating your own platform or exchange for selling or listing securities. Platforms may require registrations or exemptions to avoid serious unintended regulatory obligations, i.e. you get shut down, you lose all your money, and they come for you. So issuers have basically two legal options for a security token offering. You can go full IPO, which of course is costly and expensive, and usually these companies go public at a later stage, or you can sell a security token under an exemption from registration. Anything else is unlawful. Anything else. Exemptions from registration include regulation D, S, CF, and A+. And the plus is sort of a moniker. There's really tier 1 and tier 2 of regulation A, and we usually like to go with tier 2 for state preemption. Issuers selling under the exemptions must also stay and assess the shareholder count thresholds under 12G of the Securities and Exchange Act of 1934, or else registration is required. And this is sort of one of those landmines of risk assessment. If you start to collect a lot of investors and say you do it now, it might be more possible with blockchain and less intermediaries to do so at a lower price point. So you might gather 2,001 shareholders and $10 million in assets, and now you've tripped that 12G threshold that requires, in fact, full registration and IPO. And that would be nice to get there for 10 million and 2,000. We can only hope, but you do need to watch that. Advantages of unregistered offerings, they're here. there's less time and expense, there's less disclosure requirements, there's less dependence on public demand. It's just helpful to do an exempt unregistered offering. It just can be very streamlined. And that's what I like to, of course, start people with, is like a Regulation D. And sometimes a registered offering is more desirable if you already have a lot of traction and you already have quite a bit of assets and capital. Then it might be beneficial just to go straight for the IPO. Either way, you should look at tokenization. So when we're looking at doing exemptions from registration with the STO, the first thing that comes to mind is Regulation D. Now, there's different sections under Regulation D, which we'll get to, but in many times, this is the most efficient method for conducting a securities offering. There's a few different categories under this, and we usually like to end up at Regulation 506C. So I'm just going to breeze through. This is 504. 506B, things like AngelList, there's kind of a two-step dance you can do. But this, you're not really allowed to advertise in the same way that you can with a 506C. So for me, this is the preferred start method for an STO. They can communicate with investors through general solicitation, meaning I can take Hootsuite and blast LinkedIn, TikTok, Facebook, whatever you want, all the social media channels at once, and advertise the raise and send people directly to my website to raise an unlimited amount of funds from accredited investors. And that's the big hitch with 506C, is accredited investors. There's basically asset and income limits, and there's ways to verify that they are accredited. Now, on March 12th, we actually just got a very recent no action letter from SEC regarding accredited investor certification and funding amount. So if an accredited investor, it used to be we had to verify, income and asset, but if they're investing a minimum amount of funds, I'm looking at it now, it looks like $200,000 or whatever it is, and representations that they are accredited, that's good enough. So we now have kind of a shorter path with 506C for larger investment amounts, which is very welcome to the industry. One risk we have to look at, we don't want any bad apples in the bunch. Bad actor disqualification is huge. So I would recommend, even, say you have a group of founders and you're all friends and you've all been buddies for 20 years, it's beneficial to run bad actor checks on yourself. Directors, officers, 20% or more beneficial owners, placement agents, because you never know. I've had instances where I've seen people's identities get stolen, and there's been litigation or federal action, something on that person's identity that they were disqualified as a bad actor and didn't know it, and it wasn't legitimate, and things had to be taken care of. So even if you don't think you or your friends are bad actors and you're starting a business, it's a good idea. It's also a good idea, of course, to have directors and officers insurance as you're starting things. But one bad actor in the bunch can sort of take the whole thing down. Offshore transactions under Regulation S with Regulation D, which allows us to get to accredited investors in the United States. Regulation S allows us to get to non-US investors. Section 5 of the Securities Act, which is that big landmine we're looking to sidestep, does not limit it to the US. So if they're outside the United States, they're not really, the SEC is not really concerned with protecting them. Rule 903 is the specific rule we're looking at, and then Rule 904 is the resale rules, et cetera. This is a very good exemption to utilize, and now with the principles of non-integration or the integration doctrine that's changed over the years, we can execute a Regulation S and a D offering simultaneously. The risk, however, is flow back to the United States with Regulation S, and we want to deconflict the offerings to where a person in the United States is not viewing the Regulation S offering or documents. So it's often beneficial to firewall those offerings. So a US IP address that's supposed to be only looking at Regulation D paperwork is in fact only allowed to look at Regulation D paperwork and not Regulation S. There's been instances of very large fines for this, and for Regulation S, there cannot be any directed selling efforts into the United States. So yeah, here's these. I'm just kind of getting ahead of my slides here. Sales can't be made to any U.S. person, even if they're a U.S. citizen overseas. And of course, the person can't be physically standing here in the United States, and no directed selling efforts, advertisement, or promotional activities targeting U.S. markets for that raise can do that. Broker-dealer quotations or research reports intended to stimulate U.S. investor interest can even be considered directing selling efforts. So you need to be careful here. I would advise, whenever you're doing a raise, especially a dual sort of raise, that all of the information is run by your attorney for risk assessment before you just go crazy and start marketing and throwing websites online. Regulation CF for crowdfunding. This is sort of a more limited exemption that allows up to $5 million per year. And the big caveat is that you've got to go through a registered funding portal only. Non-broker dealers can run portals and can apply to run portals, so it's easier. I can get folks approved for that, and I can launch a blockchain-based version of this. But of course, launching and running your own portal is a little time-consuming and expensive in its own business of itself. I'm partnered with folks like Republic, which is a big CF platform, and we can run through people there with less than they're advertising now for their rate. There's a 12-month resale limitation. And the risk here is, of course, you just want to make sure you're going through a legitimate funding portal, unlike Regulation DNS, where I can connect up any platform, even like a DigiShares on the back end, without having to register the portal. Regulation A, this is kind of a mini IPO. I can raise up to $75 million a year from any investor. They don't have to be accredited. It's a public offering. However, we have to file a Form A1, do an offering circular, financial disclosures. Oftentimes I do a Regulation D paperwork. Our firm will do a Reg D and S for a flat fee of $15,000. And then later we do a Regulation A and we subtract that $15,000 from the $65,000 flat fee to begin a Reg A because we reuse our work. Permitted investors, yeah, anyone, there's a cap, of course, with their income levels and worth. So they're not just allowed to put all of their money down on everything as a non-accredited investor. And there's, of course, continued reporting with a Reg A. So this is quite expensive and time consuming. It takes more time to get the paperwork in and to get approved. And unlike, say, a Regulation D, Regulation D is a notice filing. I just tell them, here, we're doing it. I don't need permission to begin. Here's a big slide, so I'm going to spend a little more time on this slide and then cruise through more. Liability for non-compliance with an exemption. Both the Securities Act and the Exchange Act impose liability for violation of registration requirements, disclosure obligations, and broker-dealer registration. There's what's called Section 11 and 12 under the Securities Act that we have to worry about. More so sort of 11 in a roundabout civil way. And you just it's kind of a thick paragraph. But Section 12 of the Act imposes civil liability on any person who sells it by a means of false or misleading prospectus or any other sort of communication, a text, a tweet, a skywrite, anything, a whisper, a wink at the wrong time during the presentation, any kind of communication that's false or misleading is going to engage Section 12 liability. And this is for both, exempt offerings and registered offerings. Section 12 will apply for. And of course, we're looking about things that are violating Section 5. And under the Exchange Act, the primary sections that give rise to civil liabilities against officers and directors are 10B and 10B5. These are anti-fraud provisions that prohibit people from using manipulative or deceptive trade practices, any misrepresentation or omission of a material fact that prohibit any person from engaging in any kind of fraud or deceit in connection with the purchase or sale of a security. So when we're talking about a misrepresentation or omission, misrepresentation is obvious. Omission is where we need to be careful. Obviously, I want to tell you everything I know about the project and everything that's going on about the business. But if I leave anything out that's material or that would affect your investment decision, it could engage liability and exposure on this point. So you can't just say, oh, well, I didn't tell you that. I didn't lie, but I didn't tell you that. well, that's an omission that could be a problem. And especially if you think it's something that you're not telling them that could affect their decision. Oh, I'm not telling them that I paid X amount for this and I'm selling it for this. You want to tell them all the material facts and not leave anything out. And so we're just going in both provisions. Let's see, next one. I think that's a nice long slide. All right, secondary transactions. So when we're talking about securities, we have the primary transaction. I'm selling it for the first time. I have to sell it under that IPO or sell it under an exemption from registration. And we're using, DC or, DS, CF, and A to sell that. But what about a secondary sale? What happens when I want to resell that token or the holder of that wants to resell it? Well, now we're engaging secondary sales rules, and those are very important. And as an issuer, I'm not the one that's going to be standing to gain so much on these secondary sales. If I do, there's a problem. So there's resale rules to be aware of. Rule 144A, the kind of the fiction of 4A1.5, which was codified statutorily under 4A7. And essentially, all these have a little bit different spin to them. But if you're, a qualified purchaser under 144A or a qualified institutional buyer worth millions of dollars, you can purchase. If you wait long enough, essentially, and you are an accredited investor, you can repurchase these things. And of course, going back up to this slide that I sort of skipped over, we want to do the secondary sale on a FINRA registered ATS for exempt securities or nowhere else. If it's not on a FINRA registered alternative trading system, if you just launch your own website and try to have secondary trades, now you're hitting Exchange Act problems and you're going to be shut down. If it's, of course, a registered security, you're looking at major exchanges and, of course, other securities, OTC markets. Like I said, any other venue is regulatory trouble. So we've got all these lovely resale rules that we like to use to get these back in the hands of folks. And there's, of course, other laws and rules and landmines to watch. So we've got primary issuance, where we have all those rules to filter down, secondary issuance or secondary trade issues to watch, and then other things, right? What else do we have? Well, we want to avoid being an unregistered broker dealer. We don't want to be dinged with this. This will shut the business down. There could be criminal or civil liability. And you want to be sure to look for issuer exemptions and making sure you're complying. The big issuer exemption under this is 3A41 under the Exchange Act rule. It allows officers, directors, employees to participate in the sale of securities without registering as a broker dealer. You can have transaction-based compensation. So if I'm not a licensed broker dealer, I can't launch a business model where I sell other people's securities and I take a percentage of that sale. That's just not a business I can engage in without being a licensed broker dealer. But if I'm a company that just wants to sell my own securities, well, that's what this kind of exemption is for. There is a restriction on frequent sales, for example. If I do more than one sale every 12 months, I could trip this, and strict adherence is required to avoid inadvertent broker-dealer registration requirements. And this should be assessed at all organizational levels. So if I have a managing corporation and multiple subsidiaries, I have to look at every single level of the organization for unlawful broker-dealer activity. Another one is the Investment Company Act of 1940, the ICA. Are you an investment company under this act, or do you meet an exemption? And that's a big thing to look at. And again, at each level of the organization, there's basic exemptions that people typically use, 3C1 up to 100 beneficial owners, 3C5 for real estate. There's percentage requirements that have to be met, 3C7 qualified purchaser exemption, and 3C9 here, that's kind of an oil and gas. That's an older guy. Investment Advisors Act. So of course, we've got the Investment Company Act of 1940. And if we're tripping this, we also really need to look at the Investment Advisors Act, which we should look at, anyway, even if we're not tripping the latter. With the Investment Advisors Act, we want to be sure we're not advising people essentially on investments. It's kind of exactly what it looks like. And I recommend on this, when you look at your business model, you have an attorney look at it and, give you an opinion letter regarding, do you qualify, or do you need to register or register as an ERA, an exempt reporting an advisor, which has sort of a lesser form requirement to do. There's the Bank Secrecy Act to worry about. Now, this is not as direct a worry if investor funds flow directly through a regulated financial institution. The primary Bank Secrecy Act obligation is on that institution, the bank. It's not on the issuer. However, there still might be indirect obligations. They must still conduct appropriate due diligence, accredit investor certifications. They must have contractual anti-money laundering and know your customer requirements that are obviously also imposed on the bank's custodians and other intermediaries. And of course, those banks or any person should be filing SARs and suspicious reports. The risks of non-compliance, there's of course significant penalties, criminal liability, and regulatory enforcement. And of course, we need robust AML KYC compliance. Part of that AML KYC, if we know our customer, we can check them against OFAC, Office of Foreign Assets Control, at our U.S. Treasury Department. OFAC has a list. It's called the Specifically Designated Nationals and Blocked Persons list, or the SDN list, that anybody can check online. And this is for sanctioned places and people, for example, North Korea, Syria, Iran, parts of Ukraine, like the Donbass region that has been taken by dictator Putin, for example. Those are places that are sanctioned. So we don't want to let any person in from there. There are sanctions on areas. There are sanctions on business. There's Chinese military industrial complex sanctions. So say I want to do business with a Chinese company, that might be perfectly great. But if that company is making bullets or bombs or missiles or computer chips for missiles for Chinese military, that is a problem. And even one investor in the bunch could trip that mine and the whole thing goes down. Otherwise, there are percentage requirements for different countries and investors to look at. But this is definitely one of those huge areas to look at. Civil liability for sanctions and violations for this is enforced on what's called a strict liability basis. That means that any transaction or activity violating these sanctions can give rise to penalties, even if the person undertaking the activity had no knowledge or reason to know of the violation. So saying, I don't know what the law is, I didn't know I had to check, that's not going to fly. You're still going to be strictly liable, perhaps even criminally, but at least civilly for these kind of violations without knowing them. So those are kind of a lot of things to think about with the rules. When we're looking at other risks, as far as a risk assessment analysis, and I'll just sort of stop on my last slide here, we want to look at, there's of course a technical risk, and I think that was covered a little bit in the last presentation. Blockchain can be hacked just like anything else, but it takes a lot more effort. So you still want to do, technology risks associated with these offerings, and look at what blockchain am I on? What kind of attack would be required to take this chain down? And what am I doing to back up in an event of sort of a complete electronic failure? And there can be paperwork mirrorings, and there's things that we do on my side to back things up. But that's just sort of part and parcel for assessing risk with STOs. So that's the presentation. Again, Gary with Allomer Law. If anybody needs an STO, feel free to reach out to me. Here's my email, gary@allomerlaw.com, and that's my phone number for a quick question. Thanks, Gabriel.
Thank you so much, Gary. So there it is, the playbook for mitigating risk, legal and regulatory risk in the US. That was great, Gary. So we'll now move over to the EU with Javier, who's joining from Spain. So the floor is yours.
Thank you so much. I'm going to try to share screen.
In the meantime, just a reminder to everyone that you can participate in the Q&A section and not the chat section. So please ask your questions in the Q&A section, and we will answer after Javier's presentation, and just have a general discussion with all of the speakers.
Okay, it's saying me that and sorry for this because I thought that I could share with my current version. I'm updating the Zoom app in the computer. So if you give me 1 minute, I will do the disconnection and reconnection.
Okay, that's fine. I guess in the meantime, we can go to a few questions
I'm
for other.
gonna go out and come back in 1 second. Sorry.
Yeah. So in the meantime, we can do a few questions for some other speakers. Maybe Raveena, if you're there, I know there are a few questions specifically to you in the Q&A section. One participant is asking, like, what format does your risk assessment take? Is it just a PDF or is it something on the blockchain? Like, if you could just briefly explain on that.
Yes, currently it's in a PDF format, and we also use it as on our platform. Also, you can view the ratings where we describe like what metrics are assessed. We give all the information on our platform as well. But whenever we do a public rating, we also share the rating as a PDF in our LinkedIn. So you can check out all the ratings we have done so far and go through all the information.
Perfect. And Javier is back. So I guess we can go to him. Thank you.
Yeah. Are you seeing my screen?
Yes.
All right. Well, first of all, thank you for the invitation, and Raveena and Gary, thank you for your presentations. The Gary's presentation, I was especially interested because for Europeans, normally even for lawyers, we have doubts in the regulation in the States, because here it's a bit complex. We're gonna see now, but it's not more complex than in the US or simpler. It depends, no? Okay. I haven't put this presentation talking especially about the risks, but the risks they are gonna arise inherently. Okay. What I mean is that we're gonna talk about the different options of launching STOs here in the European Union, and some specialties with Spain, okay, because we are going to talk about what is harmonized in all member states and what is not, okay, and basically seeing the watching and studying the obligations. Of course, if we don't comply with some of the obligations, we will be in some infringements with the corresponding penalties. Okay, first of all, as Gary said, that first of all, what is a security token? Here in Spain and in the European Union, we have two basic regulations, okay, that regulate crypto assets. One specific, which is MiCA regulation, that regulates what Gary was saying, cryptocurrencies. In Europe, the general concept of an asset represented in DLT, in distributed ledger technology, is called crypto asset. And then we will see if the crypto asset is a security token, if the crypto asset is an asset reference token, EMT, etc. So even we're gonna go fast this side, but it's important to different. I mean to make a big difference between a security and the asset reference token, okay? Because we are seeing now a lot, and I know that DigiShares clients are seeing a lot, real world asset tokenization, which that is not a legal term, okay? That is let's say, the practical way of calling it. But a real world asset tokenization might be that token might be a security, or it might be, for example, an asset reference token or another type of token. Okay, so and in fact, for this kind of issuance, STOs and specifically, let's call it ICOs, okay, MiCA token issuances, there is an obligation, even with a model that they offer in the regulation, explaining why you are this kind of token and why, more important, why you are not this other type of token, okay? Like for the issuance, for example, of crypto assets other than asset reference token or e-money token, you have to explain why you are that type of token and why you are not a security token, why you are not like 10 or 12 different types of categories, okay? It's a bit weird, like explaining why I am not something, when if I explain why I am one thing, it should be enough, but it's not the case, okay? Then MiCA and MiFID. Both are European regulations, okay? Well, MiFID, we have the directive, but it means that it's applicable to all member states. When we are talking about security tokens, we are not talking about MiCA, okay? So if we deal with securities, none of the articles of MiCA should apply. So we go into markets in financial instruments regulations. And these regulations, the thing is that they regulate all related to the nature of the assets, okay? Some primary market, and a lot of secondary market, okay? But when we are talking about the specific, the specialty of the public offerings of securities represented in DLT, we don't have a regulation harmonizing, okay, standardizing the regulation applicable in all member states. Okay, this is very important, because I know that a lot of clients or people that are watching us now, that maybe they're interested in doing a STO, maybe in the European Union, and if they fall into the scope in one of the exceptions, because we have, as most of you must know, some like mini IPOs, as Gary said, we have something similar, and even we have, like, I like to categorize it into 3 different types of STOs, okay? And only the STO that is required to publish and elaborate a prospectus, only that one has the European passport advantage, okay, which is the right to launch one single STO in all member states, even if it's registered the prospectus in one of the countries, okay? In the other ones that we will see now, we will have to check, at least, maybe we'll have to comply just a little thing in France than in Spain, or maybe a little extra thing in Germany than in Spain, but we will have to see each of the independent countries' specialties, okay? Okay, characteristics of the offer. Well, and before talking about this, I wanted to say that, at least in Spain, okay, because our firm is we have like 12 offices in European countries, but I'm the fintech partner in Spain. So even if as I've told you, the most of the financial regulation in the European Union is the same, but let's say my most expertise, my biggest area of expertise is Spain. Okay. In any case, these characteristics of the offer is applicable to all countries, to all European Union, with some specialties. Okay, there are some offers of security tokens, of course. First, we have to do this analysis of categorizing the token. If we say that it's a security token, we have to see what type of offer we are doing, okay? There are some offers that are directly exempted of the obligation of elaborating a prospectus, which there are a couple of two, but these ones are the main ones. Offers issued just to qualified investors, offers offered addressed to less than 150 persons, investors, and offers in which the minimum ticket is 100,000 euros. Okay, if we do this type of offers directly, we don't fall into the scope of the MiFID. Okay, we can do, let's say, even if we do an offer of 100 people, even if the amount is very big, I don't know, 30, 40 million, whatever, it would be exempted to the obligation of publishing a prospectus. Okay. There is a second option here, a second category of offers, because MiFID, what it says is that below 8 million, each member state have the possibility of exempting also offers to the obligation of publishing a prospectus. Okay, so I'm gonna explain myself. If I do a 2 million euros offer in Spain, for example, each here in this part, each country has the specialty. Okay, some countries have the limit in the 5 million, in the 8 million, in the 7 million. Okay, the ESMA, the European Securities Markets Authority, has a table with all the specialties of each of the countries. It's a very synthetic table. Okay, so in the specific case of Spain, for example, if I do a security token offering of, let's say, 2 million euros to 1,000 investors, I am exempted to the publication of a prospectus. If I do another one of 2 million, it's exempted. But if I do a third one in a same period of 12 months of 5 million, now we will do in total 9 million, this third offer, I will have the obligation to publish a prospectus. Okay. And the thing is that the offers below the 8 million, they don't have the benefit of the European passport. Okay, this is, I think, very important if you want to launch the offer from one country and you want to market the offer in different European Union countries. But this is where I told you that maybe the obligation to look for the requirement in each of the 5, 6, 7 countries that you want to do the offer, maybe they are really similar. Okay, this is something important to highlight. Okay, I don't want to enter into the obligations of a prospectus, but Gary commented also in his presentation that basically is much more complex. Register a prospectus in a member state, and more if it's gonna be of securities represented in DLT. We are talking about minimum 6 months, okay, and a lot of resources, okay, and requirements. Like you need audits, financial audits. They will need to know even what you've done in the last 20 years. If you are the director, your CV, conflicts of interest, like it's similar to an authorization. Okay, so it's something big. In fact, in Europe, well, in Spain, sorry, there hasn't been yet an offer according to the new regulation that permits the representation of the securities in DLT with a prospectus. Okay, we are working. Our law firm, we are working in 3 projects of prospectus that maybe I can comment later, talking about the base prospectus. And well, we are on it. We are working on it. Okay, it's possible. The thing it's tougher. And it's also true that what we are seeing in I know in Spain and in Europe, most of the projects are at the what we are seeing since 5 years ago. These are smaller projects, no? Like projects over 8 million for sure. Maybe one single company that wants to do a financial round, and that's it. But there are some other companies mostly in the real estate sector that they do maybe offers of 500,000, 300,000, and with those tokens representing maybe debt or, well, the specific instruments, it varies, but these are smaller projects. Okay, what happens? That these projects, for example, for the real estate sector, that is really common here in Spain. The problem is that most of the projects, they are gonna go over the limit of the 8 million. Okay, so here we have different possibilities. An interesting I mean, the thing is that for projects of 400,000 euros, it doesn't make any sense to do a prospectus, register each new prospectus per offer of 1,500,000 euros, because the costs are too big, and these are projects that normally they want to launch one per week or more, no? So an interesting possibility here is the base prospectus. In the prospectus regulation, it's a European regulation, there is a specialty called the base prospectus. I don't know if in the States you have something similar. It's really interesting. And is that you can register, if you are gonna do several, 10, 20, 30, 40, 50 or more offers in one period of 12 months, you can draft one base prospectus, one single prospectus, register this one in Spain is the CNMV, no? It's like the American SEC. And you also submit and register some what we call final conditions. It's like it will be like the general conditions and the specific conditions of a contract, but in something bigger. Okay, and in this case, if they approve this, you can start doing new offers, just changing like the content, very few content, like the amount that you want to raise, the dates, and the underlying assets. No, for example, in the real estate sector, the specific asset that you want to buy with this fundraising. No, and in this case, the cost is lower. I have to say that we are working in these projects. They are, I mean, it's doable. I haven't seen yet in Europe any base prospectus for DLT. Okay, and this is because the pilot regime regulation and the specific securities markets regulations of the different member states in the European Union, they've been changed lately, okay, and they are applicable since maybe a few years, 1 year, and this is why this is still a bit new, okay? Okay, so, and offers below the 8 million, like without the necessity of this base prospectus or the general prospectus, the obligation is just like a very mini prospectus, okay, which is a document. You've seen probably some prospectus or similar document. It's a document explaining a little bit about the issuer, the project, the rights underneath the token, etc., some financial information about the issuer, and at the end, like the contractual clauses, okay? And this will be the main, let's say, regulatory obligation for this kind of offers. Okay, I think I'm good with the time. Yeah. For intermediaries or direct issuance, I put this comment here because there are some we see in our daily practice that there are some companies that they want to launch STOs, and they think that they can do it through a crowdfunding platform or through a platform that is not their website. Okay, here basically just a highlight: be very careful, because as in the States, Gary commented also that there is the crowdfunding regulation we have, or there is some regulation applicable to crowdfunding. here too is in fact, crowdfunding platforms need an authorization, is something also, let's say, big, and issuers have to be a little bit careful. For example, the shares at the moment, they are not a crowdfunding platform because they are the technological provider that they permit, let's say, to manage all the technological part related to an STO, and even you can create your own tailor-made web page, etc. But it's not a crowdfunding platform. Like, you don't see all the projects in the web page, and you can invest through these shares. No, this is something important to take into account. Okay, specialties for public offerings on DLT. I say this, I put specialties because what I've just commented here is mandatory for the traditional sector too, okay? But STOs, it's mainly traditional sector, just with an extra technological phase, let's say, okay? But when we talk about STOs, 95% of the regulation is traditional financial regulatory regulation. Okay, in Spain, I say in Spain because, as I've told you, the exempted offers, okay, and the ones below 8 million, which are the most common in Europe, you have to go to each specific country to see if they have some specific requirements, okay? In Spain, they did something interesting, which is, okay, these kind of offers represented in DLT, we understand, I mean the supervisor authority, that this is something complex. It has some risks related to the custody, to privacy, a lot of extra things related to any new technology. No, so I am not gonna oblige these companies to get an authorization from myself, from the CNMV, but I would like that another company, which I know, for any financial institution in Spain, they are called now the ERIRs, okay? It's the entidad for the registro and inscription of the tokens in the blockchain. Some companies that I know, they will have to supervise your technology. It's like a delegation of faculties, let's say, of the CNMV into another company, okay? So when doing a STO in Spain, you need that these ERIRs, which now there are only 2 companies in Spain authorized to do this supervision, they will have to do some supervisory functions, as, for example, they need a special access in your platform to see that effectively the tokens are issued in this way, that the standard of the token and the blockchain used is secure, is sufficiently public. But in case if it's public, what happens if the tokens disappear? If an investor invested 20,000 euros in a token and he I don't know, if something happens with that token, you have to establish a backup system. This means that token will still be in the blockchain, but you can create another one. In fact, some common sense obligations that the blockchain as it worked always is not compatible with a regulated traditional system and guarantees for the investors. Okay. What about the custody? If the offerer, the issuer, is going to be the custodian? If not, who is going to be the custodian? The investors, they must have their own wallet or not? The settlement, as Raveena was saying, the settlement requirements, the pricing commissions, this is also something that it has to be very clear in the smart contract and in not the smart contract, in the off-chain technology. And well, some specialties. Okay, it's not so hard to comply with this, but it's a security, but it's a regulated sector, and of course, you have to comply with certain requirements. Some specific information for investors. Of course, now as the technology is different, there are some specific risks. Now I talk about here risk specifically. And in fact, our CNMV and the ESMA publishes specific risks that you have to inform to investors. And the general obligation for any security token issuer, as I told before, no? Even if there are some exempted offers, you have to comply with some contractual obligations, which is like a mini prospectus for these offers. And of course, this ERIR, this supervisory, this financial institution that will supervise your offer, they will ask you, issuer, to all the information related to your accounting, the directors of the company, etc. Okay. And this is I think the last slide. Of course, there are some important parts that we have to take into account doing an STO. Who am I going to offer the securities? As I told you, if we do a STO obliged to publish a prospectus, we could offer without any problem in the rest of the countries of the European Union. But if not, we have to check if we have to comply with specific requirements in some other countries, except if we fall into the reverse solicitation principle, which you probably know, which is a principle that applies in the financial sector, but in other sectors too, and means that I don't have to comply. I issuer don't have to comply with the regulation of a country where I am not doing, let's say, specific or direct marketing there. Okay, like if I am a Spanish company, I am authorized by this financial institution. I'm doing the STO here in Spain, and by coincidence, of course, there is a gray area here, and this is a typical question of the clients, like, but can I do an event talking about the STO in this country? This is marketing. I mean, probably yes, but there is a gray area there. Lawyers, we don't like to talk about gray areas, but this is the gray area paradigmatic case. Okay, basically, you can have clients of other countries, but try not to do the marketing there. For example, if you have the web page in Italian, no, I don't market. I'm not offering the token in Italy. Okay, why do you have the landing page or the page where you are doing the offer in Italian? No? Of course, KYC obligations, which I'm not gonna enter into that. Privacy, tax, of course, and regarding application of other regulations, this is also important. I talked about the ECSP, which is the European Crowdfunding Service Provider regulation, but we can fall also into the scope in some offers, security token offerings that we've seen into, for example, regulations of collective investment. Okay, if we offer securities, but that security gives the right to participate in a common fund in practice, apart from doing a public offering, maybe we should comply with some collective investment regulations. I'm not going to enter into this. Maybe you have some specific questions, but sometimes we forget about the application of other regulations. For example, if we do security token offerings of representing debt in Spain and in other member states, we have to ask the banking authorities also to review some of the aspects of the debt issuance. So talk to a lawyer if you want to do an STO, because sometimes the ABC it's known, but the EFG, which is also important, very important, is also it's also important. And secondary market, I don't want to enter too much here. I know it's important, but similar to the States here, it's not permitted to, well, there are just one or two multi-trading facilities, secondary markets for security tokens authorized in Europe, according to the pilot regime regulation. In Spain, we don't have any yet, but we know for sure that in the next months we will have at least two or even more. And basically one thing is primary market, and another different thing is secondary market, which is the second and third and fourth and infinite sell of the token, no, after the first purchase. You cannot have a market in your own platform. It's true that what you can have is a marketplace where you can say, okay, I want to sell my token. You can chat with the potential purchaser and then talk outside the platform. So in practice, this is not very, very operative. There are some ways to try to manage the secondary market without falling into the regulation regulating secondary markets. For example, the company can purchase the token, can give the right to the investor to sell to the company again the token, and then maybe the company can sell it again, but not in the same. I mean, they cannot match orders of purchase and sell, and this is it basically. Regarding STOs in Spain, I don't know if I wanted to highlight something, but these are the main highlights.
Thank you, Javier. So yeah, we're gonna shift to the Q&A session, fireside chat part of this webinar. I'm gonna start off with a question for Raveena, and while I do that, Javier, there's a bunch of questions that are specifically for you in the Q&A section, and I would encourage you to type an answer, because we won't have time to get to
Okay.
everything. But if you see one that is specific for you, please do answer in writing. So yeah, Raveena, I have a question regarding a smart contract risk. It's actually I had two recent discussions that were very interesting. One was with someone who's heavily involved with the Polymesh blockchain and their foundation, and he was saying that one of the main reasons why you would want to use a blockchain that is purpose built for securities is to avoid a smart contract risk, and where the KYC is done at the chain level. And then we had another conversation. It was on a webinar actually, with someone from Blockstream, Adolfo, who works there, who was on our webinar, and they work on tokenization infrastructure built on top of Bitcoin. And so we were talking about the different decision points to choose amongst different blockchains for your STO, and he introduced this idea of smart contract risk is a very important one. So what he was saying is on Bitcoin there's no smart contract risk, contrary to others like Ethereum. So would be very curious to hear your thoughts on smart contract risk.
So in smart contract risk, it depends on the design of the smart contracts. So what type of logic you integrate with it. One of the things that you can do with the smart contract is that you can integrate the logic in such a way that there's compliance requirements are met, like the KYC, AML, and also you also can implement security through different features you integrate. Like, so for an example, like for one of the we have assessed liquid network according to what you said about Blockstream. So in Liquid Network, what they do is they have a covenant-based approach instead of a smart contract. So this approach is not so decentralized as being on a public blockchain and having a smart contract, because it's a smart contract is flexible, right? So you can have your own conditions integrated into the smart contract. But with what offers from Liquid Network, which is it offers a more centralized approach to it. It has a standard covenant-based smart contract-like architecture, and then like issuers can adapt it, which would be a great option if somebody wants, like, it's a great option for most institutional providers, for banks and other institutional providers. But when it comes to other issuers, there are certain smart contract risks that can happen due to, like, related to different attacks. But there are also ways of stopping them. You can have like rule-based access controls implemented. You can also have like token pause or freeze mechanisms, so that when there's some sort of an exploit, you have the ability to control it. So as there are smart contract risks, but there are also mechanisms which you can use to mitigate them.
Got it. And yeah, we saw with what happened with Bybit, you know, that smart contracts can be vulnerable, and it can cost you like $1.4 billion. So something to think about. Gary, I want to shift to you. Have clients come to you and wanted to tokenize on certain blockchains where you said, no, this is not a great idea. Like there may be too much inherent risk on minting on there, or not?
I have before. I've looked at the amount of nodes running on newer blockchains, and of course, you know, the less nodes you're running, the more risk. Say like a 51% attack could establish vulnerability and such. So yeah, absolutely. And I've got a team of white hat hackers that's prepared, that used to work for the government, that's prepared to attack anybody's website or platform that would like to hire them. So where vulnerability testing and penetration testing is also something very beneficial, I think, for anybody to engage in.
That's really cool. So you actually even though you're a lawyer, you look at the tech side of things. And
that's it. Yeah. Before I went to law school, I used to fly on AWACS aircraft, and I ran their airborne computer networks and systems. And I was taught this type of cryptography by the military a long time ago.
That's really cool. So so number of nodes, and is there any other criteria that would increase risk for a blockchain?
Location, power source, you know, because of course these things are power intensive. And of course the politics of the region, you know, if you're about to get steamrolled, if you're in Taiwan and you're being attacked by China every day with cyber attacks, you know, that could be a problem. If you're in Ukraine, I mean, there's just different technical aspects to infrastructure to look at globally.
Interesting. And
Gabriel,
Raveena, yeah,
Gabriel,
yep.
one question. There's a question here of Stefan, and I have a document that I remember I sent you, like, these shares like 1 month ago, explaining this relation like in detail, not my brief presentation. I mean, answering his question in detail. Can I send you this document, because I cannot upload it here in the Q&A?
That's fine. Yeah, you can send it, and they can contact us. Yeah,
I will send it to you.
Thank you.
Thank you.
And so Raveena, are there any do you do like a ranking of different blockchains similarly to the jurisdictions that you spoke of? And could you tell us, maybe you would like to remain neutral, but I was wondering if you could tell us, like, which blockchains are seen as most robust and which aren't?
Okay, so we assess blockchain ecosystems on several features. We consider the network stability, the governance mechanism, network security, the transaction finality, the output, performance output. And so we have currently assessed about we have a currently, based on the request we get, we have an assessment of about 15 different blockchains, the popular blockchains. But I cannot directly tell you which one scores better, but I can tell you that the most popular one, Ethereum, doesn't score that well.
Interesting. That's some juicy news that we can work with. I'm like a journalist trying to get stuff out of like a famous politician. But so please say more about, if you can, about Ethereum.
It's mostly because of some of it like higher gas cost, and we assess these features as well. So like currently like the layer 2 Polygon and Solana scores higher than Ethereum due to because we consider this network stability and security as well. So Ethereum doesn't score very well there in our assessment framework. But I mean, it's kind of depending on the offering and the smart contract as well. Like blockchain has an impact, but sometimes within the smart contract, there are different mitigation mechanisms implemented.
Got it. And there was another part of your presentation that I found interesting regarding custody. Because so, for example, when we present options to clients, they can either go with a self-custodial model where people come with their own wallet, their MetaMask, their Coinbase wallet, and buy the security tokens, or we tell them, they can set up a Coinbase custodial wallet, for example, and then have all of the tokens and crypto and stablecoins sit in there, and they're held in the name of the different parties, but by this third-party custodian. So I'd be curious to see like what you consider the riskiest between both models.
We consider if it is self-custodial, if it's only self-custody, to be the riskiest. If there are several options being offered, and we also consider with the custody, like third-party service providers, we also consider what type of features they have, and do they have insurance mechanisms, what type of API provider, does it have integration with all types of blockchains, or multi-sig capabilities are available. So we consider the different features of a third-party service provider, and we think if the most highly rated is when self-custodial wallet and the third-party like a wallet provider services are also integrated together.
So what would that look like? That this hybrid?
There are some offerings where it provides only the self-custody option for investors. But when we look at an offering, we consider if both options are offered.
Okay. So just side by side on different rails, and you can have the choice. Gary, do you have any thoughts on self-custodial versus custodial in terms of mitigating risk for your clients?
I mean, obviously with a custodian, if you're using a custodian, they need to be registered properly as a custodian. Obviously, if they're not, then they're not a real custodian, and it's a serious problem if there's any issue with their certification there. Self-custody is like she said, it's sort of the riskiest because you're stuck at the person storing their own keys, and there's warm storage, there's cold storage wallet. I can put it on a USB drive and wash it in my washing machine and hope that it works again, or I can store my keys on my local computer and hope that an EMP doesn't take it out or I don't spill Coke on it. But it's essentially data security like any other data security. I'm going to run, local copies, cloud copies, and hard storage copies that's in a fireproof safe if I'm storing keys, myself. There's going to be multiple locations. And then of course I have to worry about access, to those keys. If somebody hacks my computer system or my network, I have to make sure my network security is up to date. Our national security agency, it kind of continuously issues guidelines and updates on network security that people can access for free in the United States. So that's something to keep up on is basic network security. But yeah, self-storage, it's risky, but it's people do it every day with their own wallets too. So I think people are getting more technical savvy as time goes on, but they do need to be aware that if you start to lose this stuff, well, good luck. We do have people that can find it and hack in, but it can be very difficult.
Yeah, and I think one element that can mitigate that risk is the smart wallets where you can log in through your Google or Apple or whatever account, so you don't have to memorize like the 12 word passphrase, for example. So there are things you can use, and that was interesting what you said about the registration. I've heard that for custodian, I've heard that the New York Trust license is like the holy grail of that. I don't know if that's true, but maybe people should check like what kind of registration. Yeah,
definitely check. Yeah.
Yeah. So yeah, I know Coinbase has that, and I think Gemini as well. So definitely look at that when you're choosing a custodian. So I'm seeing some reactions in the Q&A. Raveena, some people were surprised that you said Solana maybe had a better rating than Ethereum. So I guess some debates around, because I think what this person is thinking of, the fact that it's more centralized in terms of nodes and infrastructure. I don't know if you want to answer to that real quick.
Yeah, more centralized in the sense there is also in terms of node validators, then the quantitative distribution is higher with Solana. Higher in the sense, not higher than Ethereum, but it has about 1,600 validators, whereas Ethereum has more than like 500,000. But what I mean is it also considers other performance metrics. When in our assessment, we consider about network congestion, throughput, time to finality, transaction success rate, execution time, cost efficiency, epoch length, so stuff like this as well. So when it comes to the performance metrics, Solana does better. And we also consider the governance mechanisms, the ESG metrics. So considering like the overall picture, sometimes, like I said, it's just a combination of a lot of factors.
Got it. So there's a question about what happens if let's say an investor has their own self-custodial wallet, and somehow the security token was stolen from that wallet. So is it the person is asking, is it mandatory in the US, like in some other jurisdictions, to be able to recreate and remint that token? Maybe Gary, you'd like to answer regarding that scenario.
I'm not sure like about the question exactly what she's asking.
Yeah, so
token. Think about what the token is first. There's different ways to describe and connect this up. A token just represents, say, if it's a corporation, it's just your cap table. So it represents a share in a company, just like a cap table is a spreadsheet that I would normally keep on my computer that says, person 1 through 100 owns shares in the company. Now it's just a distributed ledger. I'm just making a copy of that spreadsheet and I'm putting it on nodes across computers all over the world. And everybody has access to that sheet that owns a share and can see the ledger and can see that, there's my entry on the thing. There's where I have the share. So what you're providing in a sense, like in say a dematerialized, digitally enhanced security, I'm saying, okay, this is not your security itself. This is a representation of the list of securities, and you're on that list. So if I'm providing you access to the list and the list goes awry, I can have in my legal paperwork a backup saying, well, what could be determinative is the lawyer's list, right, for example, or the actual list, or how we know who is on there, or we have paperwork written in if there's something that goes wrong there, essentially. But you're still sort of the master of the list. Now, if we make it a directly represented security, then we have to worry about perhaps burning that token and reissuing that token, which we can do on different blockchains. But essentially, we want to look at what that is, and if it's an LLC, it's a membership unit, for example. It's not a stock, but it's just that representation that we're concerned with.
Right. So it's a bit different compared to let's say Bitcoin. Like if you have Bitcoin in your wallet and someone hacks into your wallet, which generally looks the way you do that is the person is tricked into revealing their passkey. But let's say someone gets into the wallet, takes the Bitcoin out. Well, you're not seeing that Bitcoin again. Like it's gone. Whereas for security tokens, right, you can have a mechanism whereby the investor goes to the issuer and says, "Hey, it's me. Someone took the token from my wallet, and can you please burn and reissue?"
Exactly.
And I
because
would,
it's not an anonymous situation. The company should know
exactly.
to know who the investor is, and if, say, they're a member of the LLC, they've signed an operating agreement. They know they're a part of that LLC. They've been accepted as a member into that LLC. So transferring just that token or just stealing access to the ledger doesn't necessarily grant that person rights to that share or that membership unit. And I'm careful on the back end with the legal paperwork and, of course, the technical setup to where we're preparing for these type of contingencies.
And what makes it even harder is the fact that each wallet needs to be whitelisted. So each person that's gonna be able to purchase the security tokens needs to go through KYC and be whitelisted, so that the wallet can actually receive the security token. So if someone were stealing security token, like we'd know who that is. So what's the point of stealing, right?
Yeah, you would know. So, somebody all in their wallet all of a sudden went up. Oh, you've got all the shares now. We know Javier's over there, taking all the shares.
So yeah, not too smart, but definitely for stable coins and Bitcoin and other cryptos, like if someone steals it, it's gone. So yeah, really, really interesting. So just looking at some other questions here. I know there was maybe some confusion, Javier, on the difference between the asset reference token and the security token. I know you typed an answer, but maybe for people that are going to be watching this on YouTube after watching the recording, could you maybe go through, if someone if an issuer is hesitant between both, what's the key criteria that they should look at?
I've published. I mean, I'm gonna answer, but I've published in the answer a link to the ESMA guidelines on the criteria to determine whether a token is a crypto asset, is a security token or not. In any case, maybe it's better that I tell a little bit the answer, because the document is really like you read it and you say, okay, I'm like at the beginning, how we test, but important first thing to say here, we cannot be both, okay? So like if you are a security, you are a security and you are not an asset reference token, okay? Like for example, if a security token permits you also to, I don't know, to use one platform, or it has some community rights or something like this, like some kind of utility token functions. If it's also a security, like if it's an asset where someone puts capital money with the expectance, with the idea of having some benefits, and that those benefits are not made by yourselves, but by a third party, the Howey test, you are a security and you are regulated, your offer is regulated by MiFID and not by MiCA. And basically this is, I mean, to know whether we are under a security or not, even this is regulation from the US, but in practice, we apply the same criteria, which is the Howey test. I think Gary mentioned it very fastly, or I don't remember. Basically, you have to comply with 4 requirements, but like for me, the main ones are these: no, someone in the purchase of this asset puts money. Like if I buy this asset freely, or I don't put an amount of money, probably we have to detail what's money. If I put some other tokens, okay, in exchange for that asset, but doing it very simple, someone puts an amount of money, he receives a token with the idea of obtaining a benefit, like a profitability, normally like an interest, not like a share, for example, is the typical case. Equity, no, is a typical case. And that revaluation of the asset does not depend in your own actions, but in a third party actions. No, so if we comply with these requirements, we probably be a security token. Probably the question is good of this person, because if you read the definition of asset reference token, you can also purchase it can also comply a little bit with the Howey test. Okay, it's a token that the value of this token is linked to an underlying asset. And the aim of this token is to maintain a stable value. There is also a gray area there of what it's how do we know that a token can have a stable value, and how we determine that cost, no? Now, people doubt if it's possible to have an asset reference token of real estate or not, because how do you determine the price? No? Also, when issuing an asset reference token, there is an obligation of the issuer of purchase to someone that has your asset reference token. They can always exchange it for funds. Okay, this is a very important difference. When you issue equity, you are not obliged the company to repurchase the share, no, to the buyer. Well, there are some differences. The definition of asset reference token and the is in MiCA Article 3. I also send the link there. But basically, the main criteria is the Howey test.
Got it. Thanks for that. There was another question asked about the difference in the legal structure between a security tokening offering and a standard security offering. So, whether the SPVs are in any way different. I know, Gary, in the US, there are preferred jurisdictions. Maybe you could talk a little bit about that.
Absolutely. Yeah. There's some jurisdictions where you're not technically allowed by the letter of the law to tokenize, say, a cap table in a corporation. And even in these jurisdictions, it's somewhat untested, because some states, they might not care how I track my cap table in my corporation. But there are states for sure that are leading the way, that say, hey, we want to be blockchain states. Wyoming, for example, they had one of the first, Tennessee had one, Vermont had one, and Wyoming had was called like the DAO LLC. And the DAO LLC is it's just what it sounds like, except every person has to have managing governance. They don't have a regular LLC code that allows for this. Now, I've emailed their Secretary of State, and I managed to slip one in that had a manager before the legislature saw it, I think, and changed it on me. But they told me, like the Wyoming Secretary of State, they said in an email, we don't really care how they're tracked for a regular LLC. But still, it's not in their code. Delaware, for example, it is in their code. Utah is coming out. They have some new code there as well. And so it's just a matter of going state to state and looking exactly at the most updated version of their code and seeing how friendly it is to blockchain and what the requirements are. Delaware, for example, they want you to have another readily accessible version of it. So you might, if you're storing it all on the blockchain and it's not in a way that you can pull it down and store it, there might be a problem. So you just need to look at each structure. But traditionally, you're just looking at the same regular decisions. Should it be an LLC? Should it be a corporation? How are my taxes going to work out? How's my ownership going to work out? And then the next level, of course, looking at those different jurisdictions. And if I'm in, California, we had some legislation for it that expired fairly recently. Do I need to start a Delaware corporation and then foreign file in California to run that corporation, which just adds another layer? But essentially, it's a similar corporate structure than what people are used to. It's just that extra line or those extra sections in those bylaws and documents to ensure that the blockchain representation is what you want it to be. Does that answer the question, Gabriel?
Yeah, absolutely. Thanks. And then maybe Javier, on the EU side, or Raveena, like what are you seeing? Are the SPVs pretty much the same or not? Oh, you're on mute. Oh, maybe Raveena first. Yeah, go ahead.
All right. So in our assessment, we suggest or we consider the bankruptcy remote structure where SPV is used as a beneficial structure, and also maybe an additional measure could be appointing a trustee or somebody who ensures investor protection in the case of liquidation. So if when such a structure exists, we consider it as a positive.
Super interesting. Yeah, Javier.
All right, now. Yeah, I think what I answered in one of the questions regarding this topic is that when tokenizing, well, any asset, but for sure, when tokenizing equity, you have to go to the regulation of that specific country because this is corporate law. Like, for example, in Spain, we have two main types of limited liability companies, sociedades anónimas and sociedades limitadas. 99% of companies are sociedades limitadas, okay? The shares of the sociedades limitadas are regulation, are corporate regulation, not financial regulation, which is more like regulated by European Union, but corporate regulation is very local in terms of each member state has its own regulation. And our regulation says shares of limited liability companies can never be considered securities. So, for example, in Spain, no doubt. I mean, it's true. It's true. Some people say, okay, you can create a token representing the share. But the thing is that in practice, doesn't make any sense, because if you tokenize a share, you have to comply with the imperative regulation of corporate law. And our corporate law for sociedades limitadas, for example, they say there is preference acquisition right of each of the shareholders to purchase the shares that are in sale. Okay, like we are the 5 of us shareholders. I want to sell my shares to a third party. You all 4 have the right, you 3, to purchase my shares. Okay, and this is mandatory. So why would I tokenize a company if I cannot freely transfer the shares? No, so I can tokenize the shares of a limited liability companies. Yes, but in that case, it wouldn't make much sense to tokenize it, because you would have to comply with our requirements. For example, transfers of shares of these kind of companies in Spain, they must go. I mean, they must be made public, the transfers, like before a notary. So this is totally anti-blockchain, no? So this is, but Sociedades Anónimas, these 1% type of companies, yes, these ones can legally be tokenized. In fact, there is the regulation, a Spanish regulation saying talking specifically about this, not the representation of these kind of shares in the LT. So sorry for my long answer, but basically you have to go to each of the jurisdictions where you want to launch.
Super interesting. Thanks a lot. So yeah, we're approaching on the top of the hour. I think we're gonna start wrapping up. Do any of you want to share some last thoughts or advice, or do you think we covered pretty much everything?
Well, don't be frightened, okay? People watching us, you are in good hands with people like Gary, Raveena, and me, and Gabriel. So there is a bit of complexity now because it's the start of this kind of technologies and STOs, etc. But it's totally doable. STOs, we have to look deeply the characteristics of the offer, etc. But it's doable, and do not get frightened.
Yeah, excellent, Javier. Thank you. I think that's what I would echo as well. There's, I've been doing this for a few years now, and I've been looking at this since it started. It's absolutely doable. We can absolutely navigate it. I had a big slideshow with a lot of landmines, but a lot of these, the Investment Company Act, these things have been around a while. These exemptions from registration have been navigated. The only thing sort of newish is the corporate law aspect and the code and the blockchain, which the blockchain's old hat to me. So it's definitely navigatable, and it's getting better here in the US. We're trying to be more blockchain friendly, and now our regulators are looking at this much more favorably. But even before that, even when we had Gensler in the SEC, even when we had a very blockchain skeptical person, I was still very confident under any administration that I can navigate the securities laws very well without worry for the clients, and be able to point out the exposure points as I would in a traditional offering. But this helps disintermediate the industry, and this is a very exciting time for the industry. DigiShares is getting ready to launch the first token, their real estate exchange, their REX, linking up to an ATS, and I think people are finally starting to figure out. Several years ago, I was like, yeah, this is where it's going. Blockchain is going towards securities and remaking the securities industry. And I think now, several years later, we're finally to the point where everybody else is seeing that, and they're seeing where it's going, and they're seeing the benefits of this technology. And I'm glad that DigiShares and Javier and Raveena and we can be way ahead of the curve here of everybody else. So thank you.
Appreciate that.
Yeah, I would also add that with risk ratings from Particula, you can also, we help in increasing transparency for the products. We are assessing the risks, but also explaining what mitigation mechanisms are in place by the issuers. So we help as an intermediary for the market to develop. So it was really nice discussing all these risks with you, and also with everybody present today.
Thank you, Raveena. Definitely better information, better markets, for sure. What a great way to end this webinar. Thank you to all three of you, and to everyone who joined. And we'll see you on the next DigiShares webinar. Take care, everyone. Bye-bye.